Rich Suttmeier, thanks so much for joining us on Wall Street Unplugged.
Hey, how you doing, Frank?
Really, really good. So I was looking forward to this conversation because, and we'll get to your 2 Second Trader newsletter in a minute, because I know we have a lot of subscribers to that. But I wanted to bring you on because you're one of the smartest people I know when it comes to analyzing the Fed's balance sheet. And what's going on today is absolutely insane, where even after the money it's spent, which is 30% of GDP, we're looking at a Fed that said, we're not even concerned about a balance sheet, which you're going to see more stimulus come out. The market conditions are favorable where Main Street's going to struggle. Wall Street's going to be doing, the people who own assets are going to be doing good, which is going to continue, right? It's going to maintain that we need to continue to hand out checks to people and provide stimulus. So this isn't a short-term thing. It's not even a U.S. thing. It's a world thing. But let's talk about the Fed balance sheet and the consequences as someone that studies this, because it seems like short-term nobody cares, but for someone that's been doing this for a long time, what are some of the things that worry you of what the Fed's doing right now?
Well, the Fed balance sheet, it's been in around the 4.5 trillion area for a long time. Pardon me. And then just before the market low in March 23, they started to spike the balance sheet significantly, and it rose to 7.16 trillion on June 8th, which was the day of the market top. So clearly this rally since the March 23 lows is purely based upon the spike in the Fed balance sheet. Now, if that starts to taper off, then you're going to see the stock market decline, because the Fed stopped increasing its balance sheet. And so that's the critical thing to look at, is to keep an eye on this balance sheet to make sure it's not peaking. If it peaks, then we have a correction in the stock market.
So I think we're all on the assumption here, at least from what the Fed's telling us, that this isn't going to stop anytime soon, right? So they're going to continue to spend money, spend trillions. They're calling it phase 4, which is going to come out, more checks to people. We're not even talking about $1 trillion infrastructure plan that's in the works that both sides agree with, but who knows if we'll get it. Considering that's going to happen, almost, I don't want to say guarantee, which is a bad word in finance to use, but should we assume that stocks are going to continue to have a bid under them? Because even when things go bad, it seems like the Fed's going to be there to back everything up and just to continue spending money.
Yeah, but I see some problems on the negative divergences on the various indices, like an island reversal for the Dow and an island reversal for the S&P. All of it, what happens with an island reversal, they gap higher, and they did on June 5th, gapped higher, and then they gapped lower on June 11th, and that created what's called an island reversal. In other words, you can circle those daily bar charts on the charts, and now the Dow is below its 200-day simple moving average, which is also a warning, since it can't get back to that island that it created at the June high. So June 8th was the high for this particular move, and we're a month away from that June high. So it's starting to show negative divergences in some of the charts, like a declining weekly stochastic reading for the Dow, the island reversal for the S&P. The only thing that's doing the bidding for the market right now is the NASDAQ. Now, I have a semi-annual risky level at 10,639 for the NASDAQ, and it's now in an inflating parabolic bubble formation, meaning that its stochastic reading is above 90 on a scale of 0 to 100, and that I call an inflating parabolic bubble. So I have a feeling that we're going to have a surprise quick downturn if you don't see the balance sheet for the Federal Reserve spike a little bit higher from its $7.17 trillion.
That's interesting too, because a lot of people out there even listen to this podcast. What there's, if we cover this stuff, every single day of our lives, every minute of our lives, but people who have jobs, they come to us and, to see what's going on, and they just reading papers. When you read the paper, the markets are all-time highs. Everything's great. not that everything is great, but they see stocks roaring higher. But yet, like you said, it's being driven by mostly technology stocks. Yes, you have biotech in there, which sometimes they lump in with technology, communication services. But when you look at, energy, financials, travel-related companies, I mean, these are still well off their highs. From someone that analyzes every sector using your black box system, are you seeing ideas out there? Even though stocks are at an all-time high, there's a lot of names that are still well off their 52-week highs.
Yeah, well, there's a when you screen with the black box tool, the black box tool provides you levels to buy on weakness and to sell on strength. But when you look at the weekly charts for a lot of these stocks, they're negative, because you've got that Dow Transports are under its 200-day simple move average. The Russell is underneath its 200-day simple moving average. And like I said before, the Dow is under its 200-day simple moving average. The S&P is hovering above and below its 200-day. So it's only really the NASDAQ that's stretching this thing to new highs. And I think that's limited to 10,639, as I said earlier, because it's in a parabolic bubble of its own. So I have a feeling the upside is limited on the NASDAQ, and it's up to the Fed to expand that balance sheet even further. And if it starts to look like it's peaking, the market's got a problem, because it definitely tracked the balance sheet higher since the March 23 lows. And that was a great observation that you seemed to imply to me when we chatted the other day.
Yeah, I mean, it is amazing. It's because, and even when you look at your system, your black box system, and I'm going to say that for a lot of systems out there, I'm not talking about the algorithm systems where these guys are front running the market, right? I'm not talking about those which they get away with, okay? I'm talking about systems like yours and so many out there, and I love yours, that have been built over decades to focus just, tons of variables, but almost all of that, everyone that has these systems, even with technicals, you're looking at earnings growth, sales growth, right? I mean, those are two factors. Even if they're little factors or they don't carry as much weight as the rest of the variables within the system, they have to be in there, because that's what drove stocks since we've been doing this for decades and decades and decades ago, right? So, but now we're seeing a market where earnings are not going higher. Sales aren't going higher. They're still declining. I mean, this is supposed to come back this year. It's not come back this year. Now it's not even 2021. People pushing out GDP estimates and earnings, returning back to normal 2022, right? That's a long time from now. But yet it's one of the first times we're seeing the market roar higher. And it's not because of companies reporting stronger earnings. It's companies like, Levi's going down 2% after they missed by a mile. Mikey, disaster quarter. Nobody cares. 95% profits are down for Walt Disney. I don't even know how they're making money, generating money, yet the stock hasn't gotten crushed. It's just holding up pretty well. Do you have to update your system to these new measures? Because everyone says, well, be careful, because, it's never really different. People say that it's different. I mean, there's things going on that we've never seen before, and it seems like this is going to continue for a long time.
Well, my system is based upon 9 yearly closes, 9 semi-annual closes, etc., down below. So it's looking at 9 years of market volatility, and my assumption in doing it that way is that 9 years of data for any stock or any market anticipates all possible bullish and bearish events. So what I come up with is there'll be a value level that could be way below a stock price, and all of a sudden, if a stock crashes, it'll go down to that level, and that's where you would buy it. And in similar vein, if a stock goes ballistic, there's usually a risky level at which to sell it. For example, if you look at, obviously, the stocks that are hitting all-time highs now, like Apple and Amazon and Facebook and Netflix, Tesla and Microsoft, there are risky levels for some of them that are there for the sell. And even with Amazon, there's a risky level at which to sell. So to me, I believe that the upside for this market and for specific stocks is now limited, and that it's time to reduce holdings, book some profits. There's nothing wrong with taking profits in a market, even if it keeps going higher. You don't have to be 100% invested to be a good investor. There's nothing wrong with booking profits. And then that gives you some room if the stock goes down 10, 20% to buy it back. And that's the way I think the active investor should be playing this game right now. If you've been in the market, you've made a lot of money, it's time to be booking some profits and trading the volatility that's going to happen. Everybody's comparing this year to 2000 and maybe 2008, where we had a pretty big market fall off. But I think it's more like 1987, when we had the crash of October of 1987. The market was going up, 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 with big volatile swings like we're getting now, from much lower levels, of course, and from 1987. But then all of a sudden, one day, there were no buyers, and it went down with the steepest percentage decline in history. And I can see that happening again in 2020, Frank.
So it sounds like you're cautious, but as I mentioned earlier, there are a lot of sectors still trading well off their highs. We saw a lot of these sectors catch a bid a little bit over a month ago, where the cruise lines, the casinos, the airlines really surged, and they pulled back some, especially the casinos and also the cruise stocks. But is there areas that you're looking at that look attractive, considering, again, as we mentioned earlier, it's really limited to a few sectors that are pushing this market higher, and there's a lot of laggards. And with the amount of money being spent, the inflation that's going to be generated, there's more money in people's pockets, which is incredible considering May, and I mentioned this stat numerous times, May personal income was down 4%, but May personal spending was up 8%. So people are generating less and they're spending more. So they're generating less in income, but they're getting free checks from the government, which is going to continue. I would think that might have to filter down to some of the players and even maybe the infrastructure players with the new plan coming out. Maybe there's some ideas or the sectors that you could share that are attractive.
Well, I think it's more of like stock-specific choices. In our portfolio, we have a Caterpillar as the play on infrastructure spending. So pretty much we cover a lot of different things in terms of sectors that we look at when we choose stocks for our TST portfolio. And so I like Caterpillar, but obviously that's also related to the China trade thing. Caterpillar tends to go down if there's bad news from China, and it tends to rally when there's not bad news on China. So there's a lot of different variables that affect the individual stocks that you pick. And when I'm looking for new stocks, sure, I have levels at which to buy it on weakness and levels at which to sell it on strength. But then I look at the weekly chart and I say, I can't recommend that. The chart's negative. So it's very strange to see this kind of dynamic where the technical tools are telling you not to buy, but the indicators of where prices are, and you see the market rally, you kind of have to go with it. And have you ever heard of the employment population ratio?
No.
Well, okay. 47.2% of Americans are jobless at the end of May. 47.2% of Americans were jobless at the end of May. In January, it was 38.8% jobless. So we're still not fully recovering from the great divide that we had, where we had the bear market decline to the March 23 lows. So there's, the statistics look good, but when you look at a chart of these statistics, you're only recovering partial of what you lost in a lot of these indicators that oh, look at this, that indicator is bullish. Yeah, sure, it's bullish, but it's not recovering to the extent that you think it should be. And that's what's underlying the underlying economic weakness that you're seeing. Like states reopen and then they stop reopening. And I mean, look at the state of Florida. Our number of cases is 213,000 cases of the flu, and it grows every day. That means there's fewer people going to the stores, fewer people shopping, and that's a problem for the economy. And on a state-by-state basis, if enough of these big states are having problems, it's going to filter down to the whole rest of the country. I mean, even my favorite restaurant here in Land O'Lakes, Florida, it's closing on July 12th. They're just staying open to get rid of the food that they have in their lockers, and then they're not going to come back until September because they can't make money with 50% occupancy in their restaurant. They need 70% to break even. And that's what you're seeing as a problem for this economy, and it's not going to stop unless we really start to see these COVID cases start to decline. And they're not declining, they're rising. But the so-called experts on the street are saying, oh, it's declining, don't worry about it. And that's ridiculous. And I think you agree with me on that point.
It is. And it's funny because when you said, with over 200,000 cases of the flu, it's COVID. But the thing is, right now in Florida, people are talking about the flu because it's going to be hard going into flu season to figure out, people, did they have the flu? Did they have COVID? More people getting tested. I mean, it's if you think, because that's a big deal. I mean, if you have the flu, I mean, people are scared to death of COVID, and some should be, even though death rates are incredibly low. But people who have the flu are going to go in, and they're not going to do anything or go anywhere, which, they shouldn't anyway. But they're going to probably quarantine themselves for 2 weeks unless they really get confirmation from tests whether they have it. But that's going to be like, how do you know the difference, and how are you going to be able to tell the difference? You're going to have to get tested, and all the people that are going to get the flu are now going to be flooding these places and getting tested thinking that they have COVID. So it is interesting to see how this is happening, and stores are going to close and what's going on. And, I love your take on the Fed too, because it just shows how this is driven. This whole market's been driven by the Fed. For me, I got it wrong because I never thought the Fed would go crazy like they are now, which they're going to be huge consequences for later on, not in the short term. The amount of money they're spending, again, guys, 12.5x. So 12.5 times what they spent in TARP to back the entire financial system has already been spent, and we're not even close to being done. 30% of GDP. So, Rich, love having you on. Love getting your take. I know you always love sharing your ideas, and I appreciate you coming on. And if someone wants to reach out to you personally, how could they do that?
Oh, you can reach out to me via email at rsuttmeier, Suttmeier, @gmail.com. And I do respond to all emails, and I do like to hear from people.
Rich, thanks again so much for coming on. And as always, we'll talk again soon.
Okay. Thank you, Frank.